Okay, this is my first attempt to make these narrative slides, so I hope you'll bear with me. Hopefully this will take some of the pressure off our time constraints in class. The first of these is from Chapter 13, the topic Rebates, Premiums, and Warranties. Actually, we'll cover warranties in a separate document because otherwise this thing gets to be too long. Now, all of these are basically the same accounting problem. It's just the nature of the liability that changes. First, the idea of a contingent liability. A contingent liability is a liability whose existence is contingent upon or depends upon some future event happening or not happening. The most commonly used example is that of a lawsuit. If you get sued, do you have a liability? Now, you've only been sued. You haven't been found guilty or liable yet, so the question is, should we accrue that on the liability? How should we disclose that? Obviously it's important, but what should we do with it? The rule is that if it's probable that a liability has been created, and if the amount is reasonably estimable, then we need to go ahead and accrue the liability on the balance sheet. Then again, that's an example of our conservatism, where we want to anticipate all losses, or if there's going to be any doubt as to an outcome, we want to err on the side of making things look bad. So, what does probable mean? According to the FASB, something is probable if it is likely. Now, that's not terribly useful. Anyway, even if it's not likely, even if it's not probable, you still want to disclose it in the notes. If you don't disclose it in the notes and you end up having a liability, you're going to get sued by people who say, look, I bought your stock, and if I had known you were being sued, I never would have bought it, and I lost all my money, and it's all your fault, and you need to pay me lots of money. And of course, the lawyers, of course, get their cut too. Ooh, bouncy, bouncy. Reasonably estimable. In our accounting systems, we need specific numbers to record as liabilities. If we don't have a specific number, how can we put it into our accounting system? Now, if we can't estimate a specific number, if we can only estimate a range, then we accrue the low value on the balance sheet and disclose the range in the notes. Now, whoops, shoot. Anyway, as an example of reasonably estimable, we'll get onto rebates in just a second. As an example of reasonably estimable, General Electric has had a plant on the Hudson River in Albany, New York, probably since the 1920s or 1930s, and for decades they dumped all sorts of pollutants and chemicals and heavy metals and PCBs into the Hudson River, and then about a dozen years ago, the state of New York said, look, you've polluted the Hudson horribly, you need to clean it up. Now, so the state Department of Environmental Protection wanted GE to dredge the Hudson River and dispose of all the toxic waste. The cost of doing that is simply immeasurable. Um, there's no telling how many cubic yards, how many millions of cubic yards of waste there's going to be, and it's all going to need to be disposed of as toxic waste. So, the amount is simply immeasurable. They have to disclose it in the notes, but they can't have a number to put on the balance sheet. Okay, now first topic, rebates. Now, as we know, a rebate is a promotional device where the seller agrees to send the customer a cash payment if the customer sends in proof of purchase and some sort of documentation. Now, rebates are meant to induce people to buy the product, based on the promise of getting some money back. Now, why wouldn't we simply reduce the selling price? Let's say there's a computer monitor that normally sells for $120, and the manufacturer offers a $20 rebate, so the net cost after rebate would be $100. Why not simply reduce the selling price by $100? Well, there are a number of reasons. First, if you reduce the selling price by $20, that means that everybody, reduces their cost, and you lose $20 on each and every monitor you sell. Secondly, you might reduce the wholesale price to the retailer, to Best Buy or whomever, but the retailer might not actually reduce the retail price to match it, so that you might simply be boosting the retailer's margins. In the case of a rebate, you're giving customers an inducement to buy your product, but they might not actually send in the rebate coupon. Market researchers try to find what they call a sweet spot for rebate values that are big enough to induce you to buy the product, but small enough that you might not actually get around to it. If there's a 50-cent rebate on a product, it might, psychologically induce me to buy it, but I'm not going to send it in because it cost me a 45-cent stamp and, 10, 15 minutes of my time to get it all together and mail it off. It's simply not worth my time. If it's a $50 rebate, I'm going to send it in. So between those two extremes, there's going to be some spot where the psychological inducement to buy is still high, but the likelihood of the customer actually submitting the rebate is fairly low. Now, when you think of rebates, this is an example of a contingent liability. We've sold a product, and if customers decide to fill out the forms and send them in, we have to pay them money. Now, there are two basic ways of accounting for rebates. Now, I know you're all familiar, you all recall how to account for bad debts, and these are very comparable accounting problems, or very comparable in terms of mechanics. In accounting for bad debts, you had two choices. You had the direct write-off method, which was essentially you don't try to estimate the bad debts in advance. You simply say, if a customer proves uncollectible, we'll charge off their bad debt at that time and call it bad debt expense. The preferred method was the allowance method, where at the end of each accounting period, you estimate the bad debts and record an allowance on your balance sheet, and then when a customer gets charged off, you close their account against the allowance. We're going to have the same basic choice in accounting for rebates, but instead of calling it the direct write-off method, we'll call it the cash basis, and instead of calling it the allowance method, we'll call it the accrual basis. So for example, let's assume we sell a product with a $1 rebate offer. During 2012, we sell 100,000 units, and based on past experience, we expect 40% of the rebate coupons to be submitted. So we expect a total cost of $40,000, 100,000 units sold, 40% redemption rate, which would be $40,000, at $1 per redemption, $40,000. And during the year, we send out 15,000 rebate checks, and we expect to send out some more in the following year. Now again, under the cash basis, we don't make any attempt to record the estimated cost or the estimated liability. Instead, we simply record rebate expense, as we write the checks. So in this case, during the year, we send out $15,000. We'd have $15,000 of rebate expense. Now, this has the same failings as the direct write-off method of accounting for bad debts. We expect this program to cost us a total of $40,000, and yet we've only recorded an expense of $15,000. We're not matching the rebate expense to the sales revenue. The sales occurred in 2012, so the expense should be recorded in 2012. We're also failing in terms of full disclosure. We expect that it's going to cost us, based on our estimates, we think it's going to cost us another $25,000. We've got this $25,000 expected or contingent liability, and yet it's not being disclosed on the balance sheet. So the cash basis has the exact same shortcomings as the direct write-off method of accounting for bad debts. Let's use the same example as before. So again, 100,000 units sold, $1 rebate, 40% expected redemption, 15,000 sent out in 2012. And please, keep in the back of your head this idea of how you account for bad debts and how this follows the allowance method of accounting for bad debts. Now, again, under the allowance method of accounting for bad debts, the only time we record bad debt expense is at the end of the year when we do that annual adjusting entry. When we charge people off, we close their accounts against the allowance that we create at the end of the year. Shoot. Sorry, this is my first time doing this, and of course the graphics aren't working out properly. There we go. So at the end of the year, we would do an adjusting entry saying, okay, in 2012 we had all these sales, and because of these sales, we expect to spend $40,000 in rebates, and we'd have a $40,000 rebate liability. Then, as we send out the rebate checks, we're paying off that liability. So, we send out $15,000, we credit cash and pay off the liability. On our balance sheet at this point, at the December 31st financial statements, we've got $40,000 in rebate expense, so we're matching the expense to the revenues, and we've also still got a net $25,000 liability. We created a $40,000 liability, and then we paid off $15,000 of it. If more checks, if and when more checks are mailed out in the following year, we'll continue to pay off that liability that we accrued at December 31st. Again, the main point is we only record the expense as a periodic adjusting entry. As we send out the checks, we're paying off the liability that we record in that adjusting entry. More rebates. Now, in the previous example, we didn't use reversing entries, and of course, you all remember reversing entries. Now, in the textbook, they do examples of rebates, premiums, and warranties, and they use, they assume that reversing entries are used, but they don't tell you, and they don't show you. So, when you first read through it, it looks a little bit confusing. Now again, what we do with reversing entries is, at December 31st, we do our adjusting entry to accrue rebate expense and create a rebate liability. Then on January 1st, we come in, and the first thing in the morning, we reverse that entry. We get rid of the liability, and we credit the expense account. So that means that, once we open the books on January 1st, the first thing we do is we get rid of that liability. There's no liability on the balance sheet. So if there's no liability on the balance sheet, that means that when we write a check, there's no liability to pay off. Instead, every time we write a check, we simply debit rebate expense. So going back to our example, as we send out the checks, we're going to debit rebate expense, and we credit cash, obviously. At the end of the year, we need to do an adjusting entry to get the proper numbers on our financial statements. We need to be sure the total expense is the $40,000 for the year, and we need to be sure that we're showing the required $25,000 liability on our balance sheet. So we do that, and we do rebate expense $25,000, rebate liability $25,000. So our financial statements for 2012 have the correct numbers for the expense and the liability. We come in first thing in the morning on January 1st, and we reverse or undo that adjusting entry. And again, what we've done is we've zeroed out the rebate liability and put essentially a negative rebate expense in our ledger. Again, the rebate expense account is a temporary account. It got closed out to zero after the adjusting entry, and now with our reversing entry, we're essentially putting a credit or a negative balance into it. So now when we send out additional checks, we're going to debit rebate expense and credit cash. Again, there's no liability on the balance sheet to pay off. Okay, so let's go ahead and do rebates, sort of a side-by-side comparison with and without reversing entries. Without reversing entries, as we write the check, we debit rebate liability. We're paying off that liability that we create at the end of the year. With reversing entries, every time we write a check, we record it as rebate expense. At the end of the year, we need to do our adjusting entry. Without reversing entries, we need to go ahead and record the expense. This is the only time we record expense, so we need to get the entire year's expense in our annual adjusting entry. So we do for $40,000. With reversing entries, all we're doing is we're bringing our rebate liability up to the correct balance for December 31st. So again, based on our expectations, we think we still owe $25,000. For reversing entries, without reversing entries, we don't do anything, obviously. With reversing entries, we reverse that December 31st adjusting entry. And now during 2013, if we send out additional checks, again, without reversing entries, every time we write a check, we're paying off a liability that was created. With reversing entries, every time we write a check, we're recording rebate expense. Both of these methods get you to exactly the same place. It's entirely up to you whether you like or don't like using reversing entries. The main thing is you can't mix your methods. You can't do the first entry without reversing entries and then the second entry with reversing entries. These are sort of self-contained modular approaches, one or the other. And just to summarize, without reversing entries, little notes at the bottom, without reversing entries, the only time you debit rebate expense is in the annual or quarterly or monthly adjusting entry. Every time you send out a check, you're paying off the liability you created in that entry. With reversing entries, every time you write a check, you're recording it as an expense. At the end of the year, you create a liability just for purposes of getting it on your balance sheet, and then you eliminate it very first thing in the new accounting period. More sort of silly, poorly made graphics. Premiums. A premium is just like a rebate. It's just that instead of sending the customer cash, we're going to send them some sort of trinket or something of value. When I was a kid, it used to be you buy 3 boxes of your favorite, high sugar cereal, cut off the box tops, send it in with $1.95, and you get a baseball cap or a baseball or a doll or some sort of child, some sort of toy a child would like. Same thing with the old Betty Crocker cookbooks. You buy 2 or 3 boxes of cake mix, send in the box tops and a coupon and $2, and they send you the Betty Crocker cookbook. So it's going to be the exact same accounting problem. It's only going to be a question of what are you using to satisfy the liability. In the case of a rebate, you send cash. In the case of a premium, you send some sort of non-cash item. Now there are 2 additional problems in the case of premiums. Okay, so there's an example. Send in 3 box tops and $2 and receive a baseball cap. Send in $2. Send in 2 proofs of purchase and $4 and receive a cookbook. Premiums do involve 2 issues we didn't have to deal with in the case of rebates. First, ooh, bouncy thing. First, inventory. We're sending out a non-cash asset. We have to have an inventory of this non-cash asset. So we've got to buy the cookbooks, we have to buy the baseball caps, we have to buy the posters or the toys, or whatever it is we're giving away. We're going to have to maintain an inventory of this stuff. Secondly, there might be some additional expenses or receipts involved. Now, of course, in the case of rebates, there is an expense. You have to pay postage in hand. You have to pay postage and their processing costs, but we tend to ignore those in the case of receipts. In the case of premiums, we've got to mail the baseball cap. We have to mail the cookbook. So there's going to be some postage or handling costs. And usually in the case of premiums, the customer, in addition to sending in the proof of purchase, also has to send in some sort of cash payment for shipping and handling. Okay, so let's assume we sell cake mixes. If a customer sends in 3 proofs of purchase and $2, we send them a cake pan. During 2012, we sell 500,000 boxes of cake mix. We estimate, based on past experience, that 30% of the box tops will be submitted, and we estimate that it will cost $1.60 to package and ship the cake pans. We've purchased 55,000 cake pans for $3 each for the premium, for the promotion, and during 2012, 15,000 proofs of purchase were submitted, so we send out 15,000 divided by 3, or 5,000 cake pans. Okay, so again, the estimated total, 500,000 boxes of cake mix, 30% redemption rate, that's 150,000 box tops. 150,000 box tops divided by 3, because it takes 3 to get a cake pan, we're going to expect to send 50,000 cake pans out. We purchased 55,000 just so we'd have a few extra, just in case. And during the year, we sent out, a portion of those. Now, I guess the first thing we have to do is figure out what's the estimated cost of this promotional program per redemption. Again, in the case of a rebate, you see it's a $1 rebate, it's going to cost you $1. In this case, the estimated cost per redemption, the cake pan itself costs $3. It's going to cost us $1.60 to ship it. But then the customer is going to pay in $2 to defray shipping and handling costs. So our net cost per redemption is $2.60. So again, what we're going to need to do is record a promotional expense of $2.60 for each cake pan that we expect to send out. Again, we expect 150,000 proofs of purchase to be submitted, which works out to 50,000 redemptions. At $2.60 per redemption, that works out to an estimated total cost of $130,000. And more the same. Okay, let's assume we're going to use the accrual method without the reversing entries. So again, first we have to purchase the cake pans, so we're going to go ahead and debit promotional inventory for the cake pans we bought and credit cash. Now, it's important that we don't simply call this inventory, because inventory as a term, as an account, is reserved for products that we hold for resale. So we don't want to call this promotional inventory or marketing supplies or something to that effect. Then at the end of the year, we need to do our annual adjusting entry to record the estimated promotional expense and the estimated promotional liability. And again, it worked out to, what was it, $260 a piece times 50,000, so that's $130,000. $130,000 promotional expense and $130,000 promotional liability. And now let's assume that one cake pan is sent out. When that one cake pan is sent out, excuse me, we go ahead and we receive $2 from our customer. We're paying off one cake pan's worth of promotional liability, which was $2.60. We take a cake pan out of our promotional inventory, and we use $1.60 for stamps or mailing supplies or whatever it is it happens to be. To record sending out the 5,000 cake pans that we assumed in the example, we simply multiply each of the above numbers by $5,000. Again, the only difference between the premium example and the rebate example is the nature of our obligation and the additional accounts we need to account for the inventory and the shipping costs. Coupons. Okay, what about manufacturer's coupons? Sometimes you get those the value pack mailers in the mail. They're full of coupons. You look in the Sunday paper, they got the glossy inserts with the coupons. You look in magazines, there are coupons. When a manufacturer puts a coupon out, say 50 cents off your favorite product, how do we account for that coupon? Are these another contingent liability that need recognition? I mean, if the retail customers give the coupons to the retailer will send it to us and expect us to send them a check. So we've got this potential liability hanging over our heads. So let's assume that in late 2012, say the day before New Year's, we mail out 100,000 $1 off coupons, which are good for a year. And let's say we expect, we expect a 10% redemption rate. So we expect to spend $10,000 on this. Should we record an estimated expense and a liability? Now, one of the reasons we use the accrual method is to match revenues and expenses. In 2012, we haven't sold any merchandise yet, so there's no revenues to match the expense again. So maybe we shouldn't use the accrual basis because we're not, we wouldn't be matching things. If we were to record an estimated expense, we'd have the expense in 2012, and the sales aren't going to take place until 2013. So maybe the accrual basis isn't appropriate. We still have this problem with maybe there's a liability though. If the customers buy our product and if they use the coupon, we'll have to send the retailer some money. So maybe the accrual method is what we should use. So cash or accrual. Ooh, look at that. According to the FASB, coupons should be accounted for on a cash basis. So the coupon payout should reduce sales revenue. So if we send out a $1 check to reimburse a retailer for a coupon they accepted, at that time we treat that as a reduction of our sales revenue. So we simply reduce our sales revenue